I want to welcome you all to the Manhattan Alternative Investment Network's, or MAIN as we like to say, live event for January 15th, 2025, entitled More Inflation is on the Way. Do you know how to profit from it? I'm Robert Akeson of the Riverside Management Group, the moderator and president of MAIN. Any comments I make are mine and not necessarily my firm's. For those of you who don't know MAIN, we are a networking group that focuses on the needs of startup, small, and emerging asset managers and public and private digital issuers and the ecosystems that support them. We are committed to bringing high-value, low-cost content and networking opportunities to these market participants globally. We are also very interested in what our members and audience think so we can make our programming more relevant to them. To guide us through this topic, we have two very seasoned portfolio managers and strategists. Now, inflation remains a dominant theme as we begin 2025, with predictions and concerns reshaping both consumer and investment community sentiment and economic policies globally. How will all this shake out? And what can investors do to best prepare for, well, whatever? The debate over the trajectory of inflation involves multiple perspectives, each shaped by economic data, business trends, and government policy decisions, which themselves may be a bit unclear, and geopolitical factors. Again, to guide us through this maze of an important topic, we have two seasoned portfolio managers and strategists, Gary Brode and Young Lim, who we will meet momentarily. Before I introduce them, though, I do want to thank our sponsors for their ongoing support of MAIN and our mission to support small, startup, and emerging asset managers and the emerging digital issuer community and the ecosystem that supports them. Our sponsors include, and you can see them up on the screen, BW Cyber, Concertive, Compliance Risk Concepts, DMA, EFSI, Mirae Asset Securities, and Solidus Advisors. Okay, so let's meet our panelists. Gary Brode is a 30-year hedge fund veteran and CEO of Deep Knowledge Investing, otherwise known as DKI. DKI works with hedge fund managers, portfolio managers, family offices, and high net worth individuals to earn higher returns in the equity portion of their portfolios. DKI provides conflict-free, well-researched stock ideas and timely market commentary, and has produced more stock picks than have appreciated by 100% or more than it has losing positions. Previously, Gary was managing partner and senior portfolio manager for Silver Arrow Investment. Young Lim is CEO of FolioBeyond, where he manages a next-generation institutional quality investment platform that leverages advanced quantitative modeling and machine learning tools. He has over 35 years of experience in the fixed income markets, primarily focused on the investment management, risk management, and quantitative trading strategies. During his 16 years at Treesdale Partners as managing partner, he was in charge of the firm's multi-manager and direct investment funds, providing alternative strategies for major institutional investors with peak AUM at about $2.3 billion. Previously, Young held a senior position in the risk management department at the mortgage desk of Morgan Stanley. Now, just a note to the audience, our panelists will be answering questions from me for about 50 or so minutes. Then we're going to open it up to the audience. However, if at any time you have questions, I would encourage you to use in the lower hand panel, you have the ability to send me questions. So please feel free to do so. Gentlemen, Gary and Lim, welcome to MAIN. So let's get at it. And Gary, I want to begin with you. I see you there. You're dialing in, thank you, from Hanoi, Vietnam. So hopefully no cables get cut here.
Let's hope.
Gary, Is it true that more inflation is on the way, regardless of who controls Congress or the actions of the Federal Reserve? I want to begin with you, Gary. Go ahead.
That's absolutely going to be the case, right? And so if we go back a little economic history, the original definition of inflation was actually an increase in the money supply. And that's the correct definition. So, over the years, people have changed that a bit to be the price index, and the CPI is manipulated in all kinds of ways. But let's look at what's happening in Washington, right? There's sort of this story that, the Democrats are the big spenders, the Republicans are the fiscally conservative, sober people. It's all ridiculous. Every single presidential administration spends more than the one before it. It doesn't matter if they're Republican or Democrat. It doesn't matter if Congress is their party, the other party, whether you have unified control over Washington or not. Everybody overspends. And right now we're in a position where we're overspending by $2-3 trillion a year. That's on balance sheet. If we add an off balance sheet spending, things like Medicare, Medicaid, pensions, Social Security, all these expenses that we're incurring but not saving for and not paying for, it's more than double that. And so basically the US government has made two decisions. One, that we can afford guns, butter, bread, circuses, and everything. But two, and this is the most important part, politically, our Congress has made the decision to lie. So if we go back to when I was a kid, which was, unfortunately a long time ago, what would happen is the government would, spend a certain amount of money, and then you'd get to, tax time, you'd have to write a check. And the discomfort of that would force people into very uncomfortable conversations where you think, well, what's the right size for government? And do I want to pay for this? Can we afford it? And, if you weren't happy with the spending plans of the current government, you might vote for somebody else. Now, our current Congress has decided to obfuscate that. And this is a bipartisan problem that's being done by Republicans and Democrats. And what they're doing is they're saying, wait a minute, we don't have to pay for anything, right? If we just increase the debt, right? It's up to $37 trillion on balance sheet right now, overspending by $2-3 trillion a year, and sort of saying, yeah, nobody will notice. Well, guess what, Bob? All of those expenses are being paid for, but they're being paid for by everyone in the country through inflation. That's how we've decided to fund the government right now. And we're avoiding those hard conversations. And the last point that I'll leave you with here is we are now at the point where interest expense is over $1 trillion a year. It's going to be around $1.5-1.6 trillion in the next year. We are printing money to pay the interest expense on money that we printed last year. If that sounds to you a little bit like a Ponzi scheme, congratulations. It is exactly like a Ponzi scheme. There is nothing that's going to stop it. You cannot vote your way out of this. I'm on record in writing all summer. I said, listen, there are lots of reasons to vote for the candidate of your choice, but inflation and spending is not going to be one of them. We cannot vote our way out of this. This is going to go until the currency collapses.
And Gary, to your point, I think we've had 5 balanced budgets since 1960. So Young, what is your take on all this?
Yeah, thanks for having me on. Yeah, I sort of agree with Gary's viewpoint. Now, in terms of rising interest rates and inflation, certainly some of that depends on the speed and extent of the move. We might have a Goldilocks scenario where you have a modest increase in interest rates and the economy keeps on humming along. But there is certainly a risk of more dramatic moves, given all the issues Gary has raised. You also have the upcoming tariff issue. In addition to the budget deficit, you have the labor market coming along at a good rate, and potentially with immigration sort of being held in check, labor costs could creep up. So all those factors point to potential inflationary pressures, and depending on the exact nature of your portfolio, you could be very exposed, or a more balanced and low duration portfolio without a lot of high beta stocks could be better positioned. But
Okay.
one thing that we will probably all agree on is that there's going to be more volatility with the new incoming administration, and depending on how the Fed decides to react to the latest economic numbers, we're going to continue to see more volatility.
I see. And now let's just pivot away for a moment from the machinations of the Fed and politics. And Lim, I want to follow up with you and ask, what impact will rising rates have on the overall economy and investment portfolios? And how will higher rates slow economic growth, increase borrowing costs, and affect various asset classes? What do you think, Lim?
Yeah, higher interest rates will certainly have a significant impact in certain asset classes. Longer duration fixed income instruments are directly impacted. The yield curve is relatively flat despite some of the steepening that we've seen. So intermediate and longer duration instruments are at risk. Higher financing costs will trickle down and impact various types of businesses. Technology will be more impacted. Now, we also have to keep in mind that, there's a difference between short-term and longer-term funding rates. So to the extent that longer-term rates go up, by bigger amounts, you're going to have bigger effects on the mortgage industry and the real estate industry that's more reliant on long-term funding. On the short end of the curve, since the Fed has more control over the short end will be less impacted by market rates, and that might continue to provide some boost to the economy.
Thank you, Lim. Gary, what are your thoughts on rising interest rates, the impact on the overall economy as well as portfolios?
So I'm actually a little more positive on this than Young is, although I do agree with him that the technology market is going to be affected, right? Those are long duration assets with a lot of growth priced in. So a higher discount rate is going to affect those valuations. And just as a reminder, right, it's not the S&P 500, right? It's really the S&P 6 or 7. So I agree with Young that that's going to be a big issue. I would just point out two things on this. One is there's all this talk about higher rates. Right now, the real rate, right? If we take the Fed funds rate less the CPI is under 2%. That is not high by historical standards. And that, by the way, assumes that the CPI is accurate. I don't know anybody who believes that. And, as the Fed cuts rates and the long bonds go up, the market is telling you they don't believe the CPI either. So I think the real rate right now is probably close to zero. The other thing is, there's, Bob, the way you framed the question is the way a lot of people are framing this question, which is, hey, wait a minute, higher rates, isn't that going to slow the economy? Or, won't that lead to, higher costs of investment? And the answer is yes, but there are some benefits as well. What you have when you have rates around zero, which is what we've had for years, is a lot of stupid investment. You get malinvestment. And having a reasonable cost of capital actually forces people into making better decisions. Yeah, it's more expensive, but having money being sprayed into the wrong places because there's no cost to it, that has long-term costs. And one of the things worth talking about are all the zombie companies out there, right?
Yeah.
These companies, they're dead, but because they don't have any interest expense, they're still walking around, and clearing out that mal use of capital is not necessarily a bad thing for the economy. So I'm not as bearish on the impact of higher rates as a lot of people are.
Okay, and Young, just as a follow-up to your answer on rising rates, okay, let's just reinforce your view on sectors or asset classes that are going to be most vulnerable in this environment.
Yeah, so in addition to longer duration instruments in the fixed income market, real estate is exposed. Real estate, as I said, is heavily financed by longer term debt. You have credit spreads that are also vulnerable to rising interest rates. Credit spreads, by the way, overall have tightened, especially on investment grade credit as well as high yield. So there is greater risk that credit spreads will widen. And the secondary effect of rising rates is that a lot of people also, especially on the institutional side, think about the percentage of treasury yields that you get in addition on corporate bonds. So at lower rate levels, that absolute premium might be tighter, but as rates go up, people are going to demand, a higher absolute spread on credit products. So that's another thing to keep in mind. And some of the other types of products that would be exposed, as I said, would be certain stocks that are more longer dated in terms of their potential benefits, and discount rates being low overall. That hurts all types of asset classes. Now, there might be some diversification plays with products like gold and even Bitcoin, but those types of products have not really been tested in the markets. Alternatives, I think, are a good place to be as long as you pick the right subsectors and as long as the income produced from the alternatives, as well as some of the hedging strategies, benefit the overall portfolio.
Okay, thank you very much, Young. So Gary, let's go back to your view on rising interest rates. Can we interpret from that holding cash savings is not going to be a particularly good place to be? And what asset classes and sectors do you feel are most promising in this environment? How should we hedge?
Yeah, it's a great question, because you can't save in dollars. Everything that we were told as kids was well-meaning, but it's no longer accurate, right? Where they told us, save, spend less than what you make, and put the money in the bank, or you save in dollars, and that money will grow over time. And that seemed like good advice 40 or 50 years ago. The problem is we are in a situation where there would be constant currency debasement. Again, let's take a little look at economic and fiscal history. Throughout history, there have been 775 fiat currencies, right? Government-sponsored currencies. They have all failed. By failed, I mean they have all gone to zero. And so, somebody could say, wait a minute, what about the British pound that's been around 350 years? It has. And in that time has lost 99.5% of its value. At what point can we call that a failure? The US dollar has been around for about 250 years. It's lost about 96% of its value since 1800. Most of that since the creation of the Federal Reserve just over 100 years ago. So all fiat fails. And, going back to the Ponzi scheme example I gave a little bit earlier in this talk, what we're seeing is an accelerating debasement of the currency. And so you can't save in dollars. And the people think a lot about inflation as an increase in the price index, and that's accurate, but I would ask people to reframe that. Think about it as a loss of purchasing power. So, Bob, think about it this way. Say you have $10,000 and you put that in a savings account. And so, you earn a few percent on that, and, you earn a couple $100. And so my question for you is, a year from now, 2 years from now, 5 years from now, will that money that you put in the bank have the same purchasing power it has right now? And the answer is clearly no. So you can't save in dollars. You need to be doing other things. Jung brought up gold and Bitcoin. I think those are both phenomenal answers simply because they're much harder than fiat currency. Gold, the inflation rate on that is about 1.5% a year. Bitcoin, as of its last halving, a little under a year ago, is harder than gold. And so, Jung was saying those assets aren't tested. I would argue that gold has been tested for thousands of years. Bitcoin, if you apply Taleb's Lindy rule, it's heading for longer than the average length of a fiat currency life, which is 27 years. So I'd say you're doing pretty well there. I also like commodities. I like energy. Remember, energy, oil in particular, is priced in dollars. If dollars are losing their purchasing power, the dollar cost of energy is going to rise. And we're at a point right now where more than half the world is desperate to increase their material quality of life. And that is 100% correlated with energy usage. I agree with Jung's caution on real estate. With that said, I don't mind the idea of lower priced housing. We're in a situation right now where young families cannot afford houses. It is screwing up their ability to start families. People aren't having kids. That's not good for society. I don't mind being in a situation where somebody other than BlackRock can afford a house. Not to make too much of a political point there, but what's happening isn't all bad if you position yourself well. And I think some of the instruments that Young and I are talking about here are really good ways to not only protect your portfolio from inflation, but to make money from it.
And Gary, if I could just push back a little bit on what you said a moment ago, I take your point that there's a long history of fiat currencies collapsing. No question about that. And first that appeared on my radar was the Wharton professor Jeremy Siegel wrote a book back in the 80s, Stocks for the Long Run. And I remember reading that book and seeing that, to your point, the purchasing power of the dollar has declined precipitously since 1800. I guess my question back to you is, isn't there some benefit to society overall in fractional reserve financial systems and fiat currencies that result in a higher standard of living, not only for people that live in the so-called dollar zone, Americans and a few nations beyond that, but the rest of the world, number one. And number two, don't you think we learn a little bit from history about this, and perhaps Bitcoin and some other alternatives that you and both Young mentioned, such as gold, can be used to navigate these treacherous waters a little bit to avoid collapse?
I would dispute the premise that having a fractional reserve banking and a Federal Reserve leads to a higher quality of life. What we have right now is a situation where the chief export of the United States is the dollar.
Sure.
And we are just living on everybody's credit right now. And
Yes.
that is terrific. It's terrific to print dollars out of nothing and have the world send us goods and services until they stop, until the bond market makes it stop. That is not a long-term plan. The truth is that if we look at long-term, where we do really well is where we have a stable currency that encourages people to save and invest. They would have a low time preference, and it causes people to say, you know what, I'm not going to spend this money. I'm not going to consume. I'm going to build something for the future.
So should we go back to gold like we had in the 19th century? You had stability then.
So I like that idea. Now, the problem with gold right now is the world economy is too large for gold to support it, and you end up with sort of ridiculous prices per ounce of gold. But a hard system, a system backed by commodities, if we may be heading for a Bitcoin-backed system or some sort of hybrid, which includes gold.
How is Bitcoin going to help us, though? If Bitcoin, so the difference between Bitcoin and gold, as I understand it, is the supply of gold expands. Eventually, the supply of Bitcoin is going to be fixed.
Exactly. And the point of this is when you do not have a money supply that grows irresponsibly, people are incentivized to not spend. And like, let's look at the converse, because what you're presenting is kind of a skewed view where you're saying, wait a minute, we've got all of these great benefits because of the financial system we have, which is built on leverage and inflation. Which again is good temporarily. But if we take a look at the other side of it, when you have huge amounts of inflation, there is no reason for people to save or to invest. What you want to do is you want to spend that money as quickly as possible. Okay. And a situation where everybody spends instantly and nobody saves and nobody invests and nobody has an incentive to build anything for the future, that turns into a very poor society. And the amazing thing about it, and as somebody who travels a lot, I can tell you, I see it constantly. The amazing thing about it is it's not just our financial system. It's not just whether we can buy TVs and cars, but it makes its way into architecture and art. And I can tell you, I'm actually in Saigon or Ho Chi Minh City, Vietnam right now. But last year I spent an extended period of time in Thailand and the Philippines. Philippines has a much higher inflation rate than the Thais do. And if you take a look in Thailand, the architecture, both ancient and modern, is beautiful. People are investing in the future there. But in the Philippines, they're not even doing basic maintenance on high-end buildings. And as a result, they have places that are just crumbling. Anything nice they build is falling apart. Take a look at the inflation rate and the debasement of the currency.
Yes.
What you're describing in terms of having an ever-expanding money supply is actually dangerous. And if we want to live nice material lives and we want to have savings and investments and beautiful art and beautiful architecture, give me a stable money supply. And whether that's gold or Bitcoin or commodities, that is, in my opinion, the best way to go. Now, that said, I don't have control over it. And deep knowledge investing, we have a no whining policy, right? You get the economy that you get. And so my view is, even though I disagree with the economic policies we have, we're still going to find ways to make money from it and make our clients money.
And thank you, Gary. That's a lot to unpack. It sounds like you're a bit of an Austrian economist there. And I want to ask Young to dive in on this. Young, what are your thoughts on that?
Yeah, I mean, some of the issues related to Bitcoin and other alternative currencies, I guess it's still remains to be seen how accepted it's going to be broadly. It's always hard to analyze instruments like commodities and gold relative to the bigger bond and stock markets, and I think although in theory, there are some hedging benefits. I think in reality, the supply demand technicals and just herd mentality tends to skew things a little bit. So I think at the end of the day, diversification is a good way to diversify and protect your portfolio.
And Young, I want to direct a question I have here from the audience for both panelists, but I want to come to you on this first. Here's the question. It seems like higher interest rates are not stopping the roaring stock market. It seems like it won't. Why would a steep yield curve with a 10-year treasury at, say, 6% stop economic growth or the stock market? There are those convinced it won't. How say you, Young?
Yeah, I think there's certainly a scenario where that would be the case, especially if the path to those rate levels is more gradual. I think the market would not like a very dramatic spike in rate levels to those levels. But as long as it's gradual and the short end is anchored at lower rate levels, I could certainly see that scenario. However, the longer term effects are going to be felt, especially in the mortgage market. Mortgage rates have hit 7% again. Any kind of slowdown in the housing market is going to have an impact to the economy in various ways. Commercial real estate seems to be slowly coming out of the distress it's been in, but any kind of resurgence in rate levels is going to impact commercial real estate as well. So there are certainly scenarios where we could come out of it in a good form, but I think the path to that level can be very rocky.
Okay, thank you. Gary, what are your thoughts on this?
I love this question. I don't know who asked it, but it's a really smart question. My view on it is it's a reflexive problem, right? And so people view this sort of as two separate things. My view on this is the same thing that's causing rates to rise, right? Which is an expansion of the money supply and inflation and people projecting higher future inflation. That's the same thing that's causing asset values to go up. And, right now we have an everything bubble. We were writing about this. Our weekly piece is called 5 Things to Know in Investing. We were writing about this last week, that we have a situation where housing prices are high, mortgage rates are high, and there are record levels of houses being built on spec. Right? What could go wrong? Right? We have a situation where half a dozen companies are leading to all of the gains in the S&P 500, right? And so, commodity prices we have an everything bubble going on right now because governments all over the world are flooding the system with liquidity. So right now, the same thing that's causing asset prices to rise is the same thing that's causing bond yields to rise. And so I don't know that one is hurting the other. I think right now they're all part of the same problem, and that goes on until the bond market says we're done. No, and that's the term is the bond vigilantes, and Young knows those guys better than I do. But I think that's where it ends, not with a particular level of rates. Young, what do you think?
Yeah, no, you make some good points. And before the market sell-off a couple of years ago, everyone, well, most people in the bond market were, younger than me, and they hadn't experienced the 94 sell-off. If you were around in 1994 in the markets, there were different factors in play, but the bond market sold off about 300 basis points in yield higher. So for different reasons, the same thing happened, in 2022. And I think there's certainly a risk of the market being blindsided. But at the same time, I think as long as there's a gradual adjustment to different levels, we might be in a semi-Goldilocks environment. But again, I think in this kind of environment, people have to manage volatility with lower risk levels.
And Young, while you're at the mic here, we have another question in from the audience, which I think you might appreciate. And that is, why haven't investors reduced duration given interest rate volatility and inflation not really being tamed in a meaningful way? What are your thoughts on that?
Yeah, I think there are a couple of reasons. One reason is tied to like a Fed, easing environment. Obviously, when the Fed eases, rates come down. But what people forget is when the Fed eases, in general, his history tells us that the curve steepens when the Fed eases, which means that longer rates may not come down as much. If anything, longer rates could go up, and that's exactly what happened last year. SOFR came down about 70 basis points. Long rates went up about 70, 80 basis points. The 2-year was relatively unchanged. So a Fed easing cycle can certainly cause the long end to go up in yield. So that's a risk that people have to keep in mind. It's a dichotomy in the treasury market. You sort of have to dissect which part of the curve you want to be on. So there are those types of risks that people have to keep in mind. I forget whether there was another part of that question.
Okay, so we talked about reduced duration given interest rate volatility and inflation not really being tamed in a meaningful way. Why haven't investors reduced duration given interest rate volatility and inflation not really being tamed?
Right, and I think a lot of investors, have a short-sighted view, or their framework in terms of bond market history is a shorter time period. So if you look at the bigger picture over the past 5 years, we've had generally a bull market, and people, tend to gravitate towards, an equilibrium rate, which is lower than where we've been historically, if you go back 40, 50 years. So I think it's a little bit of not having experienced multiple cycles. So at my age, I think you have the benefit of having been through multiple rate cycles, including the 94 sell-off. So I think part of it is that kind of viewpoint. And people are going to realize the hard way. I think the markets tend to inflict pain in the worst manner. So there was that herd mentality going back into bonds. Rates are highest it's been as of middle of last year, over the previous 3 years or so. And, people thought they were, coming in or investing at very attractive levels. But again, what they haven't factored in was where have rates been the past 30 years? And all the dynamics related to inflation and the new administration and tariffs and all of that haven't really been priced into the market appropriately. So I think the mentality is going to change, and it's going to be more split, but people just have a tendency in the bond market to be long. And I think that's certainly very risky in this kind of environment.
Okay, Young, thank you. And Gary, why don't you weigh in on this?
Yeah, sure. I think the expression that Young was referring to is that it's an old expression that markets move in whatever direction will cause the most amount of people the most amount of pain. And it's a very funny, often accurate description. I think there are a couple of things going on here. One is, and Young was referring to this, we've had a yield curve now go positive with a bear steepener, right? We had lower prices at the long end and higher yields. That was not the direction the Fed wanted to go, but that's the direction we got. And so basically, if the question is why aren't investors reducing duration, the answer is because they're being paid not to. And I'm so sorry for giving like such a simple answer to it. I'm not trying to, be sarcastic about it, but the answer is that they're not changing the duration because they're not being paid to change the duration. You can get more money at the longer end. I would also point out, now I have my own biases here. I'm not a fixed income guy like Young is. I'm really an equities guy, but those are long-term by definition. The real estate market is big right now. That's long-term by definition. And so for a lot of investors, we're really thinking, years out in how we're investing, as opposed to figuring like where on the yield curve we want to be. I'm thinking about the outlook for a company over the next 3 to 5 years, or sometimes longer than that. The last point that I would make on this, and it's a really quick one, is I also think the action of the Treasury Department matters here. Now, as anybody who's read my work knows, I am not a Janet Yellen fan. I think she's been a horrible Treasury Secretary. But one of the things that she's done, which was a huge mistake, is when rates were lower, she should have extended the duration on the government bond portfolio, our borrowings. And instead, she did the opposite and refinanced our long-term bonds with short-term bonds. And that leads to all kinds of problems, not the least of which is that they need to be refinanced more often. And so, think about it this way. If we have $1 trillion of 10-year paper that needs to be rolled over, and you roll it over in 10-year paper, you're good for the next 10 years. But if you roll it over 1 year at a time, you now need to refinance $10 trillion. And what we're seeing is that the size of the government bond auctions are getting larger and larger. Now, somebody might say, well, yeah, of course it's getting larger. Our debt is getting larger. Yes, but our auctions are getting even larger. And the reason is because Yellen is rolling that paper over on shorter and shorter durations. And we're seeing historical tail levels on some of these auctions were not doing well. And we had big, like 4 or 5 basis point tails on it, which is just a fancy way of saying that the bond auction was undersubscribed and they got less money for it than what they were hoping for. And again, laws of supply and demand apply in the bond market as well. And so if Yellen is increasing the supply of these treasury auctions by shortening the duration and rolling the bonds more often, you have more supply, you're going to get lower prices. And so part of this is a result of government action. And unfortunately, now we're in a situation where if the government wants to roll that paper over for 10 years, start to calculate a 5% interest expense or close to that on $37 trillion. And, there's your budget. Now we're way past Ponzi scheme and into, ridiculous inflation.
Yes, yes. And Young, I have to get your view on this. How do you see it the same way Gary does in terms of Treasury Secretary Yellen's tactics here?
Yeah, I agree with you. Rate. I mean, hindsight being 2020. Yield levels of 3.5%, or even below that on the 10-year, was a very attractive time to really put on a lot of funding. But I guess there was a lot of short-sightedness and thinking about short-term expenses. So. There's also risk that the long end continues to sell off, in which case the refinancing costs are going to even go up further. It's sort of a vicious cycle. So there's something to be said about better treasury management.
And Young, just to follow up to that, given the charter, so to speak, of Doge, reducing government expenses, is there, both to Young and to Gary, is there a way out of this? Elon Musk didn't sound so bullish on his ability to cut expenses. That was my take.
Yeah, I would agree with you. I think they have a challenging task ahead of them, especially given some of the processes you would have to go through to cut people in the different agencies. But seeing some of the numbers in terms of headcount at the Federal Reserve and other government agencies, they seem a little bloated. I mean, it's hard to make, like a conclusive judgment based on the high level numbers, but there is a big staff in various government agencies.
Yes, yes. Gary, your thoughts on this? Is there a way
Bob,
out?
I hate what I'm about to say. I love the idea of Doge. I think our government has ridiculous expenses. I actually did a Twitter or now X thread on, insane government expenses. We spent millions of dollars teaching Chinese prostitutes to drink more responsibly while on the job. Somebody just did a study for a whole bunch of animals, figuring out whether they had more sex when they were wired on cocaine. Like this is what our government is doing. And by the way, you're completely right. The Federal Reserve does not need hundreds of PhDs being paid, tens of millions of dollars a year. The whole thing has just gone into ridiculous. So I am a huge fan of what Elon and Vivek are attempting to do at Doge. I wish them success. I want them to succeed. They should succeed. If the universe were moral and just, they would cut $2 trillion of spending tomorrow, and I would be thrilled. Unfortunately, that's not how it works. And the reason for that is neither Doge nor the White House has control of spending. That is Congress. And so if Congress authorizes spending, Doge or the White House could say, hey, this is dumb spending. You shouldn't do it. Well, guess what? They don't have the power to cut it. And now, we go to Congress, and let's just assume that, these aren't, let's assume everyone in Congress is not financially illiterate, which is a bad assumption. That's a really bad assumption, but, let's assume that they're not. What we found is that everybody in Congress is against wasteful spending except the spending in their district. Good luck getting these guys to cut their own spending. It's not going to happen. And I would love nothing more than to be wrong. And a year from now, for these guys to have cut $2 trillion of spending, and I will come back on and admit that I'm an idiot and that I'm wrong about everything. I would love for that to happen, but I don't think it's going to.
It's interesting.
Yeah.
With the passing of President Carter recently, I was reminded, because I remember President Carter when he was in office, I was reminded that I think early on in his administration, he was an advocate of zero-based budgeting, which obviously very few organizations look to as a method going forward. But gentlemen, I have a question in from the audience. Unless, Young, you want to comment on what Gary just said.
No,
Okay. So
I'm good.
let me go to the question from the audience. We talked a moment ago about how fiat currencies are not a good store of value in a environment marked by rising rates. And Gary and Young, you both talked a little bit about gold, Bitcoin, and uranium. So the question in from the audience is, some of these, we could say, are commodities. So how should we have exposure to these assets? Should we own them through the miners, through companies, or should we own them physically? Gary, you want to take a stab at that?
I do, and it's a great question. It's one that I get from my clients and subscribers constantly. I have a decent sized position in gold. I have a large position in uranium, and I had a moderate to large position in Bitcoin turn into a massive position in Bitcoin because it's done what it's done, and I just haven't sold it. So I have a ton of exposure to these, and I get questions from my subscribers and clients all the time saying, wait a minute, if you're bullish on gold, if you're bullish on uranium, why not own the miners? You'll get more leverage. They'll go up more. And my answer is, yeah, that's eventually true. That's great. But there are a couple of things that prevent me from doing that. One, my thesis is that we're going to have continual dollar debasement. Again, think about it as a loss of purchasing power of the dollar. And if that's the case, then I want to own these other assets. And I have a pure play available on my thesis. Take it. I don't really want to complicate it with a bunch of other stuff. The second thing is, let's look at the gold miners or the uranium miners. There's the issue where they tell you, yeah, guys, don't worry. We have a certain amount of stuff underground. Maybe they do. Maybe they don't. Maybe they're telling the truth. Maybe they're lying. We all remember Breax, right? The CFO falling out of a helicopter if he fell, right? And so even if they're telling the truth, they could also be wrong. That's also a possibility. I don't want to count on that. Most importantly, a lot of people forget about the operational issues. If I want to own the miners, then I need to own the management team. Maybe they're good, maybe they're not. Maybe I need to know that they're right about what's underground. I need to own their costs, and that's been a huge problem. A lot of people have been shocked that the gold miners haven't gone up as much as gold. Well, the main reason for that has been their expenses have gone through the roof. Good luck getting people to go dig and go down in mines. The cost of labor is very expensive right now.
But you mean to say there's no scale, that these miners have achieved no, I get it. Rising costs all the way around.
Exactly. And the last point on this, because uranium is really important. People have said, well, why not just own Cameco, which is the big Canadian producer? And the answer there is Cameco is a fantastic company, but instead of increasing their mining capacity, they are actually buying uranium in the spot market at a loss to serve their long-term contracts. They're basically saying, we don't want to buy more. We'll lose money buying in the spot market. You know what? I'm going to avoid all of these problems. By the way, Kazatomprom, the world's largest producer, they're underproducing right now. They keep lowering their production estimates because they can't get enough sulfuric acid. These are all problems I don't want to deal with, right? And so instead, I'm just going to own the spot and just be locked in on my thesis. And by the way, every time Cameco underproduces and every time Kazatomprom can't get enough sulfuric acid and they lower their production estimates, guess what happens? You make more money owning the spot. That's really where I want to be. I want the clean thesis. I don't want to have to deal with the rest.
Young, any thoughts on this?
No, I agree with Gary. Pure play strategies are a lot better. There are a lot of ETFs that give you specific exposures and you get the liquidity at the same time. So I fully agree with Gary.
Okay, and I have one other question in here from the audience. Denationalization of money, is that achievable? Gary, Frederick Hayek. Now, in other words, go back to before the Banking Act of 1863, when there were multiple money systems. You had banknotes, you had coins, et cetera, et cetera. Does the future, and I think part of the question emanates from your espousal of owning gold, Bitcoin, and other commodities, right? So going forward, is it possible to have a system, a money system, a financial system that has diversity, that's not just locked in to the fiat currency, to legal tender?
At the national level, I think we're stuck with the system we have. And it's a bad system, but the Federal Reserve exists. And no matter how many times I think we should end the Fed or how many times Ron Paul says it, it's not going to happen.
Young, what do you think? I'm sorry. Go ahead, Gary.
Last point on it quickly. What we do have the option to do as sovereign citizens, as individuals, is to opt out of that system. I only own enough dollars to pay my bills. Right? You can own gold, you can own Bitcoin, and those options are increasing. They're increasing ways to hold them, spend them. So I would just encourage people, make good decisions with your own money. Don't worry about the stupid things the government's doing.
Okay. Young, alternatively, what happens if falling interest rates influence inflation? And should investment strategies be adjusted in that case? How will the yield curve look then? If rates are lowered, investors might question whether inflationary pressures will resurge and how to position portfolios in light of a looser monetary policy. What's your thoughts on that?
Yeah, I think people need to focus on certain subsectors of the market, especially in the bond market in that kind of scenario. Any kind of reduction in short-term rates will be inflationary, causing the yield curve to steepen further. By the way, the yield curve has steepened. It's probably in the order of 50 basis point kind of spread between the 2-year and the 10-year. But historically, that spread has been greater. So there's more room to steepen. So in that kind of a steepening scenario, I think you maintain a relatively short duration. You want to have some duration to benefit from falling interest rates, but you want to be protected from any kind of sell-off at the long end. So a combination of floaters, some short duration credit. I think investment grade corporate credit is very tight, so it's more high yield, short duration credit, and certain strategies and alternatives, including strategies such as our Riser ETF, which invests in MBSIOs. It's alternative income. It gives you interest rate protection. It's a good offset versus all types of credit exposures you might have, but it generates income at the same time with an agency portfolio. So having alternatives of that type to complement your core portfolio would be beneficial. Now, having said all that, I think we all have to be dynamic in rebalancing the portfolio. We've learned the last few years that keeping a static portfolio will certainly blindside you, and especially in this kind of juncture where you're not sure whether the Fed is going to ease once or two more times or three more times this year. You certainly have to be dynamic and rebalance the portfolio as necessary. And
Okay, so
that's
you
one of the
described
approaches we use.
some tools to protect us from inflation and interest rate volatility, right? So we're talking about inflation protected securities. You mentioned some commodities and alternative investments.
Exactly. Alternatives, some commodities. Not a big fan of TIPS, inflation protected treasuries,
Yes.
because you have a significant duration component to TIPS. So 2022, you had surging inflation, but rates went up as well. So TIPS underperformed. But instruments like our Riser ETF, floating rates, some commodities, and more shorter duration corporate credit, I think, are a good place to be at the current time.
Okay, Gary, your thoughts on this?
I don't think that it's likely to happen, right? I don't see the path to it. And just to give you an example, to get to lower rates, I think we'd have to have a massive recession, and Congress will deal with that with spraying money into the economy again, which causes more inflation. I think we're at a point now where the Fed has lost control of the situation. Yeah. That's exactly what we saw. They lowered rates in an attempt to, they lowered the Fed funds rate in an attempt to lower borrowing costs. Well, we get, right? We got a 100 basis point increase in the 10-year yield. And what that's telling you is the Fed does not have control over this. Now, this is something I've been talking about for more than a year. In November of 2023, I wrote an ebook called Counterintuitive Inflation, basically saying, even if the Federal Reserve raises rates, we're still going to have more inflation. And the reason for that is because spending out of Congress has just become so enormous that interest expense takes over. This is something Lynn Alden has talked about as fiscal dominance. I've talked about it as counterintuitive inflation. But the point is, the things that the Federal Reserve used to be able to do in order to affect the yield curve, they can't do anymore. The only solution to this is lower spending out of Congress. The Fed doesn't have control anymore. So if you think we're going to get lower spending out of Congress, again, I would love to see it, but I don't think anybody from either party is going to vote for it. It's not going to happen. So I just don't see this as a likely path for us. Okay.
And I know there's been some discussion amongst the two of you about, let's say, the decreasing appetite of foreigners to not only hold dollars, but to buy our treasuries. How do you see that playing out, Young?
Yeah, that's always a risk, especially given the souring relationship with China. The Chinese government is a heavy holder of U.S. Treasury, as well as other Asian countries. So I guess the rhetoric of the new administration has to be, careful about alienating the foreign investors who tend to be a big part of the buyer base. So
how big are they? I thought China and Japan don't comprise more than 10%, do they, of the total bond float?
Well, yeah, so 10% is still a
Okay.
pretty decent number, but they do have other investments in other types of U.S. bonds. So
okay.
So I think there is a risk, but you raise a good point, Bob. The U.S. government market has a tremendous amount of depth, so it's not just a small subsector of the market that's going to influence levels. I think what's going to dominate is the amount of refunding that'll be required and the ongoing budget deficits that we'll have to finance. So I think those are still the primary factors.
And as Gary seemed to say, it appears to be no end in sight of our desire to spend at the federal level.
Yeah,
We
exactly.
seem to be on a trajectory that's unsustainable at some point.
Yeah, the Congress is getting, I mean, whichever administration takes power, budget deficits have increased, and you have a lot
Yes.
of different initiatives ongoing, which would continue to increase the budget deficit.
Okay. Listen, I have a couple of questions in from the audience here. I want to get to them before we run out of time. 4 years of tariffs. Okay. What are the consequences of that all be? And is the way we're going about negotiating all this appropriate, and will it be effective? And let's be quick on this. I'm going to start with you, Gary.
All right, I'll spit this out really quickly. Normally, I would go with the classic example, right? We've all read Porter's comparative advantages stuff, and technically it all makes sense, but there are some problems with it. Let's even leave aside the fact that we've hollowed out our middle class and manufacturing capacity, which is a national security issue. We have an issue right now where China, 90% of our pharmaceuticals come from China. We have a problem with them. They can just say, you know what, grandma dies. That's a problem. During COVID, the PPE was not as effective as we hoped it would be, but we weren't producing that ourselves. Everything in the world, including all of our military hardware, everything that's leading to a higher material quality of life, all of the chips,
Rare earth metals.
Yeah, exactly. That's all produced overseas. Yeah, Intel has some plants here, but they're years behind Taiwan Semiconductor. Samsung, Qualcomm, excellent producers as well. So we actually, for a variety of reasons, need to onshore some of this stuff. And even if it's going to cost more, and listen, normally I'm a guy who says, I care about the finance. I'm a finance guy, right? But I don't like being in a situation where all of our chips, all of our protective equipment, all of our pharmaceuticals, we're depending on other countries and not such friendly countries for everything that we need.
Okay.
And that's a problem. Let's onshore some of that, even if it costs more.
Indeed. Young, your thoughts on this?
Yeah, I think in reality, there will be limited actions related to tariffs. I guess it's a lot of posturing, as we probably found out in the first administration of Trump. But I guess, to the extent that we get some concessions along the way, I think will be favorable to the U.S. economy. But, we certainly are going to have a pretty volatile market environment that reacts to every little piece of news.
Yes. And Young, commercial real estate loans are generally for 5-year terms. As low rate loans mature and get rolled over, what impact do you see on commercial property?
Yeah, that is a continuing concern. We were sort of slowly coming out of that distressed environment, but a lot of the commercial loans are even 10 years in maturity. So I guess a lot of those longer maturities are going to mature in a few years, depending on when they were originated. And so the refinancing risk is there, and any kind of additional rise in long-term rates will have a negative impact on commercial real estate.
And Gary, we've heard a lot about AI recently. What about labor productivity in the next 2 to 3 years? How do you see that playing into labor inflation? We've talked a lot about rising inflation, and of course, labor is a big component of that. What do you see happening in 25, 26?
I think it's going to take a little bit longer than 1 or 2 years, but we have seen these cycles throughout history. The obvious examples are, the movable, the printing press, movable type, automobiles taking over from horses, typewriters, word processors, computers taking over, people typing, and typesetters. We've seen all of this stuff before. Long term, they do lead to productivity gains, but it takes some time and there are dislocation issues. I don't think any of this happens or much of it happens in the next 1 to 2 years. The one place where I think we're going to see a really quick response is in the call center customer service area. Those are expensive, and AI is getting very close to the point where it can start handling a lot of those phone calls. And very soon, it's not just going to be the text version of it. I know people personally who've switched their businesses over, and the AI systems are handling customer complaints better, faster, with a higher success rate, setting up meetings, making more sales. So I think if you're making your living as a customer service or sales rep on the phone, you may be in trouble in the next couple of years.
Okay, gentlemen, we've just about run out of time here. In fact, we really have. But I'm going to ask both of you in 30 seconds or so to give us any closing thoughts. Are there any messages or topics that you want to cover at a high level as we get ready to sign off here? Young, I'll start with you.
I think we all have to be very dynamic in our portfolio allocation process. It doesn't mean rebalancing the portfolio every week, but it's hard to have a 5-year plan. And as markets change and as the economy changes with the new administration, it'll be good to keep an eye on what part of your portfolio needs rebalancing to give you the maximum returns.
Thank you. Gary, your closing thoughts, please.
Our motto is no complaining, roll with the changes. So, I know a lot of what I've said today is very negative, and that's just a fact of the world we live in, but we can still make money in a bad market with bad money and bad policy. Those things don't have to stop you from protecting your home, your life, your retirement, your portfolio.
Yes.
You can even make money from these things. And we work with people to help them do that. Even if I think policy is bad, we're going to find a way to make money for our people. And that's what we focus on every day.
So, gentlemen, thank you so much. On behalf of Maine, I want to thank Gary Brode, President of Deep Knowledge Investing, and Young Lim, CEO of FolioBeyond, for sharing their insights on this very important and timely topic for investors.